China's Ministry of Finance has just issued a major update. The previously imposed 34% tariffs on American imports have now been raised dramatically to 84%. In response, President Trump has pledged a new 50% tariff on Chinese goods. This is in addition to other recently added tariffs and on top of earlier ones already in place. The total tariff rate on Chinese imports into the U.S. now stands at a staggering 125%. China, meanwhile, has fired back by increasing its duties on U.S. products to 84%, up sharply from 34%. This escalation has returned to the forefront of headlines, with the trade dispute growing more intense. Trump appears to be reacting urgently, though this time the situation is unlike previous confrontations. On April 9th, Trump had temporarily lifted tariffs on several other U.S. trade allies for a 90-day period. While this came as no shock, it spurred an immediate surge in U.S. stock markets. However, that optimism was short-lived. The crucial oversight: China was excluded from this relief. Rather than de-escalating, Trump has now expanded the tariffs on Chinese goods from 104% to 125%. In return, Beijing quickly raised tariffs on U.S. imports to 84%. But China's counterstrike didn't stop at tariffs. The Chinese government is reportedly considering a powerful financial move that could send tremors through the U.S. economy, selling off its enormous reserves of used Treasury bonds. With tensions rising between the two largest economies on the planet, this development could reshape global trade. Sources say China is weighing the sale of up to $1.1 trillion in U.S. debt, a move being dubbed a trade nuclear option or economic atomic bomb. So what would this mean? Why is China putting this option on the table, and why are U.S. markets reacting so violently? Let's break it all down. The fallout from such a decision wouldn't just affect Washington and Beijing. It could disrupt the entire global economy. We'll examine the data, expert analysis, and long-term implications. If you're engaged in this topic, don't forget to like and subscribe, because the next steps could reshape the financial order worldwide. At first glance, China dumping U.S. bonds was long thought to be highly unlikely. But the renewed flare-up in the tariff war on April 2, 2025, has defied expectations. Leaked memos on social media suggest that Chinese banks and the central bank have been instructed to reduce purchases of U.S. dollars. Simultaneously, news outlets report that China has begun reducing its Treasury holdings. This strongly suggests that Beijing is preparing to unleash its ultimate financial countermeasure in retaliation for U.S. economic pressure. Financial analysts warn that if China sells off a substantial portion of its Treasury bonds, U.S. borrowing costs could climb rapidly. The value of the dollar might slump, inflation could intensify, and domestic financial markets could face sharp disruptions. This scenario is precisely what social media has likened to an economic atomic bomb. China is among the top holders of U.S. debt. For decades, it used part of its trade surplus to buy U.S. bonds, supporting America's budget gap while safeguarding its own reserves. But now, Trump's aggressive tariff escalation seems to have convinced Chinese policymakers to weaponize this bond stockpile. International reports indicate that Chinese financial institutions have halted further dollar investments, hinting at a gradual departure from U.S. assets. The current sell-off in the bond market is intensifying, with UK media noting increased volatility and rising yields. Wall Street is clearly feeling the heat. Historically, China avoided selling U.S. debt in bulk because it would hurt its own holdings. But with economic ties fraying, a lose-lose outcome is now seen as increasingly possible. As we near the final quarter of 2025, the standoff has reached a critical stage. China has just announced an additional 84% tariff on U.S. goods, further driving the wedge. Trump has signaled that he's willing to negotiate, but claims he's waiting for a call. Meanwhile, China demands the U.S. lower tariffs first, and neither side is giving an inch. This is why the possibility of a Chinese bond sell-off is now being taken seriously. It's no longer just speculation, it's a looming threat. Some experts caution that a large-scale sale would harm China's own financial reserves. Others argue that China may be willing to absorb short-term losses to corner the U.S. economy. A more calculated approach, selling smaller amounts gradually, could still be highly disruptive without self-inflicted damage. This potential shift could also alter the balance of global markets. Other major bondholders, such as Japan and European nations, are also concerned. If yields rise dramatically, global capital could flow out of U.S. markets into others perceived as more stable. This isn't just a bilateral dispute anymore. It's a global risk. President Trump insists victory in the trade war is inevitable, yet Washington is now hinting at openness to renewed talks. Experts warn that if China sells even a portion of its U.S. debt, it could significantly impact America's borrowing power and push the administration toward compromise. Still, neither side appears ready to back down. Many believe this is Beijing's strongest move yet, but not its only one. Beijing is also exploring diversification, reducing dollar reserves, boosting the digital yuan, and pursuing more trade in local currencies across Asia. Market sentiment in the U.S. has already shifted dramatically. Bond markets have seen increased sell-offs, and inflation fears are growing. Global funds are rebalancing portfolios out of caution. Some observers note that Trump's tariff strategy may now be backfiring, as China's retaliation triggers ripple effects across global finance. While full liquidation of U.S. bonds by China remains uncertain, even the threat has rattled investors. In Washington, concerns are mounting. Members of Congress are voicing fears that the tariff war might hurt the U.S. more than China. They warn that this could be self-inflicted damage. Others argue that the total size of the U.S. bond market is so vast, even a Chinese sell-off may not create long-term damage. Yet short-term volatility could be extreme, particularly if confidence erodes. As we head toward the possibility of a 2026 financial downturn, the stakes are getting higher. In a world still recovering from past financial crises, any destabilization of the bond market could spiral quickly. Analysts warn of parallels to the protectionist policies of the 1930s, which preceded the Great Depression. Today's dynamics may differ, but the risk is real. Trump continues to insist on a better deal. China says it's ready to negotiate, but only if tariffs are removed first. This deadlock makes it more likely that China could actually sell its bonds, turning the pressure dial even further. The scale and speed of such a move remain unknown. Would they sell everything at once, or start with measured daily releases? Either way, the result could shake confidence in the U.S. dollar, raise interest rates, and possibly usher in a recession. Experts are divided. Some believe such an aggressive move could hurt China as well, but Beijing increasingly feels boxed in. And as tensions build, many are asking, are we witnessing the countdown to a financial explosion? Economists now say that bonds, once a stabilizing force, are becoming a battleground. Publications like The Guardian describe the scene as a panic-driven sell-off. The cost of borrowing in the U.S. is rising, inflation threats are looming, and warnings of a 2026 recession are echoing louder. While Beijing claims this is just a defensive move, its direction is clear: lower reliance on the dollar, reduce U.S. bond exposure, and assert financial autonomy. Many voices say China could emerge the winner, especially if U.S. exports in agriculture, tech, and automobiles take a hit. Others say no one wins in this fight, it's mutual destruction. Global financial institutions are urging calm. They fear another crisis akin to 2008 if bond markets remain unstable. This, some argue, could be a historic inflection point. What began as a tariff spat has now ballooned into a financial standoff with global stakes. Some are calling it Trump panic, as the administration grapples with the fallout. The message from markets is clear: the longer this drags on, the greater the risk of systemic collapse. As the world watches, headlines from Forbes and CNBC highlight growing anxiety. From mortgage markets to inflation, the effects are rippling out fast. Should China move forward with the bond sell-off, the shockwaves won't stop at U.S. shores. In the end, whether Trump relents or China pulls the trigger, national pride on both sides is keeping compromise at bay. And that leaves one big question for the world to ponder: are we heading toward a long-term financial conflict that could stretch into 2026? Let us know what you think. Could this be the collapse of the U.S. financial shield, or just a strategic bluff? One thing is clear: if China acts, the global economy will feel the impact. Stay tuned for our next edition. The financial fault lines are shifting, and the next move could change everything. Thanks for watching.